Well, good morning and welcome to the IML Large Cap Portfolio Positioning and Prospects Update. My name is Wayne McGawley, Head of Retail here at IML, and it's great to have you guys on the call. It is disappointing for everyone, the current situation we find ourselves in and our inability to get out and see our clients face to face. We did actually sneak a roadshow in during the March. There's a small window there, and we're pleased to get out and but anyway, we'll do what we can with what we can. So thank you for joining us. Today we've got Hugh Giddy, Head of Research and Senior Portfolio Manager, along with Daniel Moore, Portfolio Manager, who both cover the IML Large Cap Funds, and we're also joined with Michael O'Neill, Portfolio Manager of the Co-Portfolio Manager of the IML Equity Income Fund. The plan today is to give you guys an overview of where the portfolio positioning and prospects for both those portfolios, the IML Large Cap Funds and the IML Equity Income Fund. Listen, it's very discussion based. There's only one or two slides. It's a lot of Q&A, a lot of discussion, and we encourage you to send questions through on that little box you see on your screen. So thanks for joining the call. Hugh, let's kick off with you. We've just finished reporting season. What were your general observations of how reporting season went?
Well, Wayne, the reporting season was very strong overall. A lot of that strength was the very strong commodity prices we've had in the first half of the year. And, you know, most of the mining companies had, you know, blockbuster results, particularly in iron ore, where the price has been exceptionally strong. But the interesting thing is, of course, what's already known is those commodity prices. So there weren't many surprises in the resources space. And in fact, a lot of the resources went down. So it shows that you've got to sort of not only sort of understand if a result is going to be good, but how much is already priced in. A lot of our companies did very well, you know, and they had good results and actually did quite well on the result day because perhaps the market realized that the results were a little bit better than expected. So it varied, you know, obviously from sector to sector, but the resources sector, although very strong, because the iron ore price is now falling, dragged on the market.
And you specifically would want to comment, excuse me, on a couple of key stocks during the reporting season worth noting?
Well, you know, Wayne, we had several really strong results where the share prices responded favorably. Some where the results we thought were very strong and the share price didn't move up so much, like News Corp had a blockbuster result in its real estate classified division and didn't actually go up for very long. But if you look at Brambles, Amcor, CSL, Telstra, Steadfast, Fletcher Building, you know, a number of great results that showed the strong underlying businesses that, you know, it's a variable period. We're still in a bit of a false economy where you've had a lot of government stimulus, you've got generationally low interest rates, and then you've got you know, different levels of lockdown around the world because of COVID.
Yeah, we'll come to that. We've got a few questions on that, Hugh. Daniel, thanks for joining us today. In terms of market themes, can you just share with the guys on the call what you're seeing as far as market themes today, please?
Sure, Wayne. Probably putting COVID to one side, I think we've all probably talked that topic to death. Probably the major theme coming out of all the company meetings we had was really the supply chain disruptions and the cost pressures a lot of businesses are having at the moment. And it's really through freight. Freight rates are up significantly, particularly in air and shipping freight rates. Labor rates are up, and obviously commodity costs are up. Normally, in a normal environment, these cost pressures would be bad for company margins, but because there's a number of product shortages in the marketplace, the manufacturers or the suppliers have been pretty bold with their price increases to offset those cost pressures, and a number of those companies have delivered, you know, very strong results in the face of that inflation, and that's really because buyers or the big, large global retailers have been willing to accept those price rises, which are normally pretty tough people to get price rises through, but we've seen it, and that's really because of the product shortages. They need the products to sell to their customers, so they've been, I guess, willing to accept those price rises.
And Daniel, we see continued activity in the merger and acquisitions. Any comment on that?
Yeah, M&A is incredibly strong. I think we're close to a record M&A year this calendar year already, and we still have several months to go. I think at last report, there's still 500 billion globally in cash sitting in funds of private equity funds around the world that's yet to be deployed. So that continues to be a really strong theme. Fortunately, we've benefited from a number of those, whether it's Tabcorp, Spark, Link, or Z Energy recently, and that's just in the large caps. Small caps has had a number as well, and that's because private equity is looking for really cash generative businesses, and they're looking for franchises that are durable. They're looking for those sorts of businesses, and we own a number of them. So, the fund continues to benefit from those, and long may it continue.
Yes, it's certainly been a part of IML's history to own stocks that the market doesn't necessarily recognise the value or the quality, and other companies or private equity do. In terms of overall portfolio positioning, Hugh, can you give the audience a bit of a sense of how the portfolios are positioned?
Well, the portfolios, we've got to be aware that sentiment is very, very favorable towards markets. Financial assets generally have been pushed up a long way because of central bank money printing and very low interest rates. So housing prices are going crazy around the world. Bond yields are exceptionally low. I think in Germany, the 10-year bond is still yielding a negative return. There's a negative interest rate attached to a 10-year supposed investment. And you've got breathtaking stupidity in some crypto areas. People are paying a lot of money for things that have absolutely no value, little pictures of things, digital pictures. You can't even hang them on your wall as far as I'm concerned. So I'm not sure what people are doing. And so you have these very frothy markets generally, and we do find a lot of our industrial companies have been largely left behind, not necessarily completely, but left behind, still offering good value, particularly on a relative basis, but also on an absolute basis, where you're getting attractive yields, good cash flows, and so that's how we position ourselves. We talked at the roadshow about how some companies haven't gone anywhere for 3 years, despite the market going up substantially, and despite those companies increasing their earnings and doing better. So it gives us a lot of comfort to know that we can invest in good companies and not feel like we're paying top dollar. So we feel very comfortable and confident about the portfolio, and some of that has come through in reporting season, where those companies delivered and the market not only accepted the result, they re-rated the company post the result release.
Yeah, good. Thanks, Hugh. And that's certainly one of the key messages for our clients is the latent value that sits within the portfolio yet to re-rate. Daniel, on iron ore, Hugh touched on it previously, but can you talk to our view on iron ore and how we're positioned with the iron ore stocks?
Yeah, sure. I mean, I think it's fair to say iron ore has really hurt funds' relative performance in recent times, and it's been very painful. But we've been really disciplined and careful not to chase the momentum. And that momentum really peaked around May, where the iron ore price hit an all-time high. It actually wasn't far off inflation adjusted. And despite the iron ore companies producing phenomenal, as Hugh already said, phenomenal results, very strong cash flows, fantastic dividends, we know through history, investing in commodity companies when the commodity price is at an all-time high, it is a bad strategy. And you only have to go back to the last iron ore price spike, which was February 2011. And if you look at the prospective returns for the iron ore companies post that peak in the iron ore price back in 2011, over the next 5 years, BHP, for instance, was down 40%, including dividends. So we've been disciplined, and we're quite happy that at the moment that discipline's been rewarded with the iron ore price now falling, as there's some growth concerns in China, as they're talking about policies of wealth redistribution, and the iron ore stocks are down roughly 20%. That's helping our performance at the moment.
Thank you, Daniel. Just expanding on that point about a number of stocks being left behind. Have all these opportunities gone as far as stocks yet to re-rates? Have you got any other examples to share with us?
Sure. Sorry, Wayne, who's that for?
Sorry, Hugh, excuse me. I'm sorry.
Okay. I thought it might be for me anyway. Yeah, look, we were talking in the roadshow about Telstra, and how it's really been beaten up over the years because they're losing their fixed line business. Well, not the complete fixed line business. They still sell you broadband, but they have to increasingly sell you an NBN broadband package rather than using their own copper. So they've lost a lot of earnings with that, and then they also lost earnings in the mobile business, where they're very dominant. They have greater than 50% share. They have the best mobile network. But Optus decided, I'm not sure, who the clown was. Well, I think we know who the clown was, who thought that if they cut prices, they will somehow, make more money. And Optus cut their average revenue per user from around $60 per month to $35 per month on average. When you drop your price that much, in order for you to make more money, you effectively have to roughly double your number of subscribers. Probably a little bit more because of the admin costs of more subscribers. That didn't happen. So Optus went into loss, but Telstra had to follow the pricing down, and they therefore made less money in mobiles too. Optus began to really suffer. Vodafone, coincidentally, has never really made money, so they weren't doing well either. And when you had only one player making any money at all, which was Telstra, we knew that the industry would have to become more rational, and you started seeing mobile prices go up. So in reporting season, for the first time, Telstra actually half and half increased EBITDA in many years. In about 5 years or 4 years, Telstra for the first time could say half and half, we're making progress. So the share price has gone up, but Telstra does have a lot of very valuable assets, infrastructure assets, like the ducts and exchanges that the NBN uses for their fiber optic cable. They've got the mobile phone towers that they sold for a very attractive valuation, and they still are the telecommunications leader in Australia. So we see that the dividend will be underpinned and is likely to go up. They have strong cash flows and they have good assets. So we still think there's prospects, despite an appreciation in the share price, for further appreciation.
Daniel, can you comment on a couple of stocks also that you cover?
Sure. I think a couple of stocks we talked about at the previous roadshow in March, stocks that have been left behind. One was Sonic, and Sonic, one of the largest global pathology players in the world. It was a really strange one where the share price was pretty much in line where it was pre-COVID, despite being a significant beneficiary of COVID testing. And our forecasts were the COVID testing revenues would generate them an extra $1 billion this financial year above their normal level of earnings we were forecasting. And at the time, I think when we were presenting in March, we said, well, if this continues much longer, the company will have almost no debt. Yet the share price hadn't really moved despite the significant improvement in earnings. And to put that in context, the profit in the first half for the February or the December half was up 160%. And really the flattish share price was implying that COVID revenues were not going to last much longer. It was a one-off. And our view was COVID revenues were likely to last longer than people think. And there was a risk that new variants emerge, much like the Spanish flu, and the revenues under some scenarios could be very strong. And unfortunately for us all, that's happened with Delta. And the COVID revenues have grown significantly, and the profits of the company up substantially, and the share price has now followed. So the share price since March is up over 40%. Where we sit today is we're almost at the opposite end of the spectrum now, where the share price is getting close to capitalizing those COVID revenues into perpetuity. Not quite, but it's getting there, and that's probably unrealistic as well. The level of COVID testing that's going on today won't last forever, and there's potential for reimbursement rates to come down, or the use of rapid antigen testing, which Sonic would make way less money. So today we're just starting to trim that position now, whereas in March it looked like a really good buy. So that's done quite well for us. Probably the other one, which Hugh mentioned briefly, was Brambles, and again we mentioned in March. In March, Brambles was down 25% from its pre-COVID levels, which just really made us scratch our heads because the profits, the cash flows were better. They grew their earnings and cash flows all through COVID. They had a really strong balance sheet, and they were continuing to win market share and improve the quality of the business, over the past sort of 18 months. It was quite a strange one, and fortunately since March, they've delivered some really good results, particularly this reporting season. Revenue was up 7% and EPS was up 15%, which was a great outcome. Despite all the cost pressures they're facing with lumber, freight, and labour, the management's just done a brilliant job over a number of years, actually improving the quality of their contracts, so they've got cost pass-throughs, and they continue to take market share as warehouses around the world continue to automate. And as warehouses automate, they require a very high quality pallet, a pulled pallet solution, not a whitewood pallet, which is roughly half the market. And Brambles is really one of two suppliers of these pulled pallets in virtually every country in the world, major country at least. So they've continued to win market share from the whitewood pallet market, delivered really good growth. And it's pleasing to see the share price starting to re-rate. I think it's up 20+% from the March lows, but it still looks very attractive. It's still below its pre-COVID levels, and we still think there's a fair way to go.
Hugh, thank you, Daniel. Hugh, you talked more about the confidence in the portfolio, which has come through in a few of the stock stories you guys have covered. But from a risk point of view, Hugh, where do you see the risks in investing today?
Well, I think everyone's been aware of the potential for inflation to come back. Now, interestingly, central banks seem to want inflation. I'm not sure why we should want to devalue our purchasing power, regularly, but that's what central banks have decided. That's the RBA has a target of 2 to 3%, and many central banks have a target of 1 to 2. And inflation now is there. You're getting a lot of price increases. Wages are going up in many places. If that inflation is sustained, and it's more than just the central banks keep saying it's transitory, then they will have to raise interest rates to bring inflation under control. And that will take a lot of the air out of these very speculative stocks and other speculative assets. If interest rates go up, when you're not getting any earnings currently, but you've got lots of hope, there's wonderful future, that justifies paying vast prices for companies that make no money or very little money. If your alternative is a reasonable return, safe return in the bank, or a safer return in the bonds, people, I think, will return to looking at companies that are actually making money now, reliably, with strong cash flows and so forth, as we invest in. Any time valuations are high, one of the risks is that, your future returns are crimped. If you look at history, when valuations are well above trend, your likely future returns over the next 5 to 10 years, which is a long period, it's not a short-term forecasting mechanism, are going to be quite weak. And once again, if that is the case, then you want to be in companies that are good companies, are quality companies, have reliable cash flows, pay good dividends, so that you can easily work out some sort of total return that will, in all likelihood, exceed what may be a relatively muted market return overall.
Yeah, thank you, Hugh. And Daniel, a question around ESG, excuse me. Can you just provide a bit of an update to how ESG is incorporated into the IML process?
Sure, Wayne. With ESG has really been part of our process ever since I've been at IML. It has been one of the 10 factors in our quality scoring system, and it's in every research report we write, which goes to the investment team whenever we consider a new idea. So it's always been there, but about a year ago we did a company offsite, and we always look to try and improve our process, and one of the topics was ESG, and we really looked at it all over again, our whole process around it. And what changes we made was we made ESG a higher factor in our quality scores. So it's gone from one of 10 factors to a 25% weighting. So it's been up-weighted within our quality scoring system, and we've placed additional hurdles for companies that may score low on ESG for possible inclusion in the portfolio, which requires much more onerous research requirements, much more onerous valuation testing around all sorts of factors like remediation costs and carbon tax potential costs, things like that. So practically what that means is if a company has a low ESG score, to be included in the portfolio, the investment hurdle rate's now higher, quite a bit higher than it used to be. And then for stocks in the portfolio which do have a lower ESG score, you'll probably see those stocks sold a little bit earlier than previously, just as the hurdle rates are different today.
Okay, thank you, Daniel. Just before we switch to Michael O'Neill, I just wanted to share with the audience some work we did with a firm called Foresight Analytics. Foresight Analytics is an independent asset consultant that provides performance and holdings analysis for investments, for clients, for asset managers, super funds, and the like. We do have a full report available. That's available on request, but the reason we engaged Foresight Analytics is because they are independent, they are very empirical based, and what we wanted to do is use some of that work to convey some of the messages that were being underpinned by today's message. The first one is, overall, it's a demonstration of of the IML portfolio, in this case the IML Australian Share Fund, on almost every metric is trading at a discount, its largest discount to the market and many of our peers. And that's demonstrated in these three charts. The first one, it's inverted this chart, so that is the earnings yield of the book value of companies has never been so high. The earnings yield over the price, the share price, which is inverting the PE, has never been so high or near its highs. And then there's a cyclically adjusted PE as well. And all of that is to demonstrate much of the qualitative and stock-specific messages that the guys have shared with you today. That, and to Hugh's point, that your future returns are determined by the quality and the asset value you buy or you own today. So I think that's an important point to empirically display the numbers to back up what the guys have said. The 4 report, as I mentioned before, is available to our clients, and it's just a case of requesting that for your state manager via email. Let's just bring Michael O'Neill into the call. Thanks for joining us, Michael, and thanks for sitting by patiently. In addition to the points you raised on the reporting season, is there anything you'd like to share with the audience as far as reporting season as it relates to stocks and the equity income fund?
Yeah, thanks, Wayne. Certainly outside the stocks that Hugh and Daniel have talked to, there's plenty of examples of income generating stocks with strong cash flows and balance sheets where we've seen recovering dividends. And in some cases, we've actually seen capital returns in our stocks through special dividends and buybacks. I'll probably start by highlighting Amcor, which Hugh mentioned very briefly. One of the world's largest primary packaging suppliers. They supply rigid and flexible packaging, and over 95% of their sales are into defensive end markets. This includes things like food, beverage, and healthcare. So because of that, they've generated very steady earnings and dividend growth over time, not only organically, but also through bolt-on acquisitions. So you can see why this is a quality company that's appealing to IML. What we saw in the recent result was that Amcor was a beneficiary of COVID in terms of the trend towards eating at home. But even if you back out these high volumes through COVID, the underlying growth was still quite strong, and they're still getting decent cost out and synergies post their acquisition of Bemis. So because of these strong cash flows, the outlook for further bolt-on acquisitions and also further returns of capital through ongoing buybacks is quite strong. Another one I'd highlight is Suncorp. It was a highlight in reporting season for our income fund. Hugh has mentioned, I guess we do take quite a cautious approach to financials. Suncorp is an exception. It's one of the better quality financials in general insurance. It operates in a near duopoly in home and motor insurance. Those are quite favourable markets because the insurers compete on service rather than price. And we have seen those businesses turn a corner. Competition has abated somewhat. Their retention is actually showing signs of improvement, and management announced a special dividend and an on-market buyback, citing their improved confidence in meeting their long-term financial year 2023 targets for margin and return.
Michael, dividends. It's been one of the most extraordinary periods of dividends in the history of the Australian share market. Normally such a reliable and dependable source of income and return for investors, and you had it's almost been a feast or a famine, and been very topical in the most recent reporting season.
That's right. I mean, we are at a point, Wayne, where the outlook for income and dividends from defensive industrials is actually quite compelling. During COVID, things were a lot less certain. A lot of boards were being quite conservative and quite prudent with their capital. In some cases, we saw defensive businesses raising equity because the environment was so uncertain. So now there's plenty of potential for recovery in dividends, and you don't have to look purely at the cyclical sectors such as iron ore to chase yield. And obviously, Daniel's mentioned our caution around that sector in particular coming off peak earnings. What we're seeing is the yields of low-risk industrial stocks actually look quite solid, and particularly when you compare them to the other, traditionally low-risk classes of income, such as fixed income, property, and cash. So there's a few examples there on the slide you can see. Daniel and Hugh have talked to stocks like Brambles, Sonic and Telstra. All of them pay reasonable yields, as you can see there. Some of them also have specials or buybacks in addition to that ordinary yield that you see on the slide there. Amcor and Suncorp being examples, and also Sonic having the potential for future return of capital if there's or else acquisitions. And it's interesting because during last year, option income was quite important with the dividend uncertainty, so it did provide a natural offset. But you can see from that slide that the option yields available today at what is a more normal market where yields are less uncertain is actually still quite decent, even if you're just focusing in on the defensive stocks you see there. So you can take a stock like Amcor, write a call option 3 months forward and generate quite high income potential for that stock. I mean, another resilient source of dividends in the portfolio, it's been the supermarkets, Coles and Metcash, you can see there. We have been through a period of what was quite prolonged aggressive competition and price deflation. Now we're seeing food inflation. And in fact, if you focus in on Metcash in particular, we're seeing strong performance across all divisions of that business, the supermarkets, liquor and hardware. The trend towards shopping local seems to be here to stay, and they're reinvesting in their business. And I guess the last thing to highlight from that slide is that we don't exclusively target stocks with options in the portfolio. AusNet has a compelling 5% yield from essential energy infrastructure assets. In that case, the yield is locked in. The earnings are smoothed by the regulator on a 5-year window. And the growth in the dividends for AusNet is assured by the billions of dollars that's being invested in renewables that ultimately need to be connected to the grid. So the appeal of assets like this is quite clear, and we saw that really underpinned by the recent bid for Pierre Spark Infrastructure, which we also hold in the portfolio.
Yeah, I mean, on that slide in particular, just going back to that slide for a moment, Michael, it's incredible to think with a cash rate at 0.1, and it's been thereabouts for a while and looks to be thereabouts for a while to come, that you have these yields on good quality companies that have got real earnings and balance sheets. It's quite incredible. If you were to suggest that would have happened, say 5-7 years ago, a zero cash rate and finding those kind of yields on industrials, not many people would believe you. Reflection of the risk appetite at the moment and the source for total return, which we're seeing reflected in the growth stocks and the momentum stocks, because of what we've always tried to convey to our investors, there's more to this than just value versus growth. It's really fundamentals versus momentum. And again, that's reflected in that foresight report, but that's available too. Michael, the options you've touched on, the banking sector. Can you provide a bit of context on the outlook for the banking sector, how you're positioned in that sector with the portfolio?
Sure. Well, I mean, what we have seen through COVID is a very strong recovery in the banks more recently in the fourth quarter of last year. Fair to say the stimulus has been very effective, and we saw a rapid decline in the volume of deferred loans on the bank's balance sheets. We're now seeing write-backs of bad debts, so negative bad debt charges amongst the banks. House prices are surging with low rates, and the banks are in a position of returning some of their excess capital through renewed dividends and buybacks. So, you know, the outlook does look a lot better than we might have expected at the depths of last year. Now, the franked yield has always been appealing to investors. It's just a little bit over 4% yield across the banking stocks, and that is tempting. The one thing we need to be cautious of with a cyclical sector like the banks is not to overly concentrate your portfolio in these assets. If you look at the sector, the margins are still in structural decline. Cash rates are near zero. The majors are losing share, and there is a race towards a digital mortgage. So in this environment, in trying to maintain their earnings, banks need to focus on improving their efficiency, but also cutting costs to hold up their earnings. So with a dividend averaging just over 4% and share prices at 1.8 times net tangible assets, which is actually much higher than banks overseas that earn similar returns on equity, we see much lower risk and in some cases higher income prospects in the defensive industrial stocks.
Michael, in terms of the equity income fund, it's now 10 years old, a little bit over, and it's got two clear objectives, because it is running money on behalf of a certain investor profile, so to speak. The first being delivering income over 2%, 2% above that of the broader ASX. And you could see with the previous chart you had on, it is prospectively looking like that's going to be quite achievable, and historically it's been fine. And important to note that distribution over that 10 years is almost largely or entirely made up of those two things. It's dividends pass through and the option income, not capital. Then, of course, the other objective is to mitigate the volatility or the risk and be lower risk than that of the ASX, which it's managed to do through its life as well. The other aspect that is important, Michael, and we're well aware of it, but I think it's important to touch on and share with our clients, is the prospect for unit price growth over time. How do you see how do you answer that exact question? What's the prospects to grow that unit price over time?
Wayne, I guess from what we've heard from Daniel and Hugh regarding stock picking and valuations, there are plenty of defensive industrials out there with solid yields that can grow their earnings. There's plenty of examples in our portfolio of stocks that are reinvesting back into their business to get that compounding effect. They're taking out costs, they're making accretive acquisitions, or they're restructuring their businesses to unlock value, which is quite lucrative in a low rate environment. So although we've seen, particularly in this reporting season, the recovery in several of our stocks, there are still plenty of high quality stocks that have been left behind. Yeah. So by no means has the re-rating of defensive value finished. It's got a long way to go. And I guess the other thing, in the context of a portfolio that does use options, we always avoid covering with call options those stocks that we see as deeply discounted relative to their intrinsic value. So we would never write call options on stocks that have significant upside to their valuations. Where we do write options is where we see stocks approaching our valuation, and we do so with a target exit price in mind.
Yeah, thanks, Michael. So I'll just bring back the other guys. I've got a few questions coming through and want to make sure we allocate sufficient time to cover those. Hugh, my first question goes to you as in your role of head of research is when you're looking at some of the changes that have occurred as a result of COVID, how do you work out which changes are permanent, which changes are temporary?
Wayne, obviously forecasting the future is not anyone's great skill. I think it's fair to say most people are not very good at forecasting far out. What you can say, I think, is that the effects of COVID itself are likely to dissipate. We're going to either have to live to learn with it, or it will die out to a large degree as a virus of concern. But you've seen a lot of impacts in the near term. No one traveling. Is that likely to be sustained? Well, certainly. Let's hope not. You had a lot of travel happen overseas when they do open up. Most of the things I think are not permanent. The thing that might be accelerated and stay higher than it otherwise would have been are things like online shopping. People have got used to the convenience of online. They've kind of got into some habits that way. And who knows? Maybe people's behaviors will change a bit. People will, keep signed up to some streaming media. Things like Netflix and Stan. Whereas without COVID, maybe they wouldn't have felt they had the time to subscribe to 2 or 3 of those services.
Daniel, I've got a few questions which I'll try and group together, but in essence, they're all around valuations in the market. And I know we've touched on it, but nonetheless, we're getting questions. So clearly, it's something that's on investors' mind about, is there much value around with the market at record highs?
I mean, at a sort of headline level, you'd say not a lot. I mean, markets are at all-time highs. And for a lot of businesses, because as Hugh talked about, when this false economy, their potential sales and earnings have been elevated because of stimulus payments. There's definitely many sectors which don't look attractive, and just because of the whole amount of liquidity has been pumped into markets by central banks, particularly the assets which are more speculative in nature or more cyclical in nature, assets which drive returns really from capital gains opposed to dividends. Those share prices have been driven very high. So that there's really not a lot of value there, as you can imagine, just because the risk appetite's just so favourable for those companies. But in the sort of pond we're fishing, which is that sort of more lower risk, higher quality industrial company that will do quite well in most economic environments, those companies have been, in a relative sense, left behind for sure, which we've mentioned many times. And the valuations look good on an absolute basis, but on a relative basis, look outstanding. Probably the cheapest we've seen, probably since I've been at IML, really since 2010, 11, post GFC. So we're finding plenty of good low risk opportunities, I guess. Companies, and what's really odd is the outlook for these companies is really strong. Their balance sheets are strong, and they've done a good job improving their businesses through COVID. But for whatever reason, they've not been in favour, which is good in a way, because we've been able to increase our exposure to these sorts of companies, and hopefully it provides a good outlook for prospective returns for our funds.
Michael, question around companies' reaction to interest rates. With interest rates remaining low, will companies reduce their dividend yields? In other words, reduce their payout ratios?
With interest rates remaining low,
so low, does the incentive for companies to continue to pay high dividends, will they just say, well, okay, I don't need to pay a yield of 4%, I'll just retain the earnings and reduce the payout ratio?
Well, we certainly haven't seen that in the Aussie market. It is a market that favours franked dividends. I guess really it depends on the company's prospects to reinvest. Certainly where a company has opportunities to buy businesses and do so in a way that's quite disciplined against their cost of capital, we'd love to see that. I think growth is hard to come by at the moment, though. So I would say that that those companies with lots of growth opportunities are probably edging on the side of redeploying capital. But there aren't that many companies with I guess substantial growth opportunities ahead of them. We're not seeing any trend away from I guess paying out earnings at the moment. Guys, can you think of any example where low rates is driving lower payouts?
No, it's the opposite. If anything, payout ratios are higher because the balance sheets are stronger, and companies are trying to make themselves look more attractive sort of asset, I guess, relative to the alternatives. Which
if you look across the banks, the actual balance sheets of corporates and SMEs is quite high. There has been a lot of courting of cash, and if anything, that does underpin strong dividends from here.
Yep, Hugh, we're getting quite a few questions on inflation and interest rate outlook for the next 3 years. How would you answer that?
Well, as I mentioned earlier, the central banks are trying to assert that the pricing increases we've seen in a multitude of things are transitory or temporary. Either that they'll be a one-off thing, and after that prices will be very well behaved, or that they are temporary and will actually be reversed. It's their whatever playbook that they want to keep interest rates low. They want the governments to be able to have extremely high budget deficits. It's called financial repression, where you keep interest rates well below a market level, and so and it allows governments to borrow very cheaply. So the government budget deficits, which are being funded effectively by reserve banks, are a lot more manageable, because they can borrow so cheaply, and the costs of the interest on all that debt that the governments are accumulating is very cheap. The truth is, when interest rates are below their normal levels, it's very likely you get inflation. And already we've had a lot of inflation. There's nothing to do with supply constraints or anything. It's in asset prices, but of course they don't measure asset prices in the CPI. But eventually, things like very high house prices do feed into workers' wage demands, or will feed into higher rents for people who are renting, that sort of thing. So I find it hard to believe that we're not going to get some sort of inflation. If we don't get inflation, which is completely conceivable, that I think will be because growth is extremely disappointing. We have some sort of recession or downturn that puts a lid on prices, that puts a lid on spending, and I don't see either thing as being good for sort of high growth or forecast high growth stocks in general, because either interest rates go up to control the inflation, or growth is very disappointing generally, and and more staple companies that will do well then, compared to companies that are very dependent on a very favorable environment.
Thank you, Hugh. I'll just wrap things up there, just conscious of our time, but thank you, Hugh, Daniel and Mike, and thank you everybody for being on the call. A CPD points and video recording will be sent out in due course. I guess just to bring together the core messages, IML's focus on value and quality remains. It's served our investors well over decades. It's had a challenging period in a momentum-driven market, but that won't last like that forever. And I think also the important message is diversification is also relevant. IML's approach and the way in which we invest is disciplined, but it's quite differentiated from the index and many of the growth guys or other value styles. So we think the complementarity of our portfolio is important. And the number one lesson for creating wealth, it's about buying quality assets at good prices and being patient. And at the end of the day, with all this noise going on, that rule should serve our investors well, and we stick to that. So thank you everyone for your time, and take care. Thank you.